Welcome to Moving and Selling a House with Jim and Judy. This course uses the self-study delivery method. It's a tax course. There are no prerequisites, no advanced preparation. The course level is overview, and it was last updated in February of 2017. My name is Carolyn Weaver, and I'll be your narrator as we follow along with Jim and Judy as they move and sell their house. In modern America, it is rare to find a person or family living in the same place for 30 years. Most of us move 5 to 10 times, which means deductible moving expenses can become an issue. If you're like most people, you hate moving. But when you're out buying moving boxes and bubble wrap, you need to keep track of your expenses. This course reviews what are deductible and non-deductible moving expenses so you won't miss out on some good deductions. We'll discuss who can deduct moving expenses, what costs are deductible, time and distance tests, special situations, and reimbursements. Let's review a brief history of the moving expense deduction. The deductibility of moving expenses is covered under Section 217 of the Internal Revenue Code of 1986. The last major change in allowable moving expenses occurred with the passage of the Revenue Reconciliation Act of 1993, which was effective for expenses incurred after December 31st, 1993. The principal changes eliminated any deductions for meals, house hunting, temporary living, and buying or selling a residence, and changed the distance requirement from 35 to 50 miles. The Act also permitted an exclusion from income for reimbursed deductible expenses, with any unreimbursed deductible expenses deducted by the employee above the line rather than as an itemized deduction. As a result of this act, the only deductible moving expenses left are for moving household goods and travel, excluding meals, at the time of the move. Jim and Judy, along with their daughter Jessica and their dog Jojo, live in Fargo, North Dakota. After an especially cold winter, they decide to move south to Houston, Texas, because they've heard there are a lot of good jobs there. Neither Jim nor Judy has a job lined up, but they are confident that they can find a job after they move. Jim has had a full-time job at Sears for the last 10 years selling snow blowers. But because she was a stay-at-home mom, Judy has not worked outside the home for the past 12 years. They plan to rent a U-Haul truck and do most of the packing and moving work themselves. Judy is wondering which moving expenses are deductible and how much it is all going to cost, since they won't be receiving any employer reimbursements. And Jim is not sure if he needs to keep all of his receipts or just some of them. Who can deduct moving expenses? You don't have to have a job lined up before you move. As long as you meet the distance test and the work test discussed later at the new location, you can claim a deduction for moving expenses. The move must be related to the start of work. You can't deduct moving expenses if you never get a job at the new location. So even though Jim and Judy don't have a job in Houston prior to their arrival, they still may be able to deduct their moving expenses. Who is considered a member of your household? A member of your household is defined as anyone who lived with you at both your former home and your new home. It doesn't include tenants or employees unless those people are also your dependents. So if Jim and Judy had a nanny for their daughter, any separate moving costs for the nanny would not be deductible. Who can deduct moving expenses? You can only deduct moving expenses that are reasonable for your situation. The cost of traveling from your former home to your new one should be by the shortest, most direct route available by conventional transportation. In other words, Jim and Judy can't deduct the cost of a side trip to Disney World on their drive from Fargo to Houston, and they can't travel by wagon train or hot air balloon. But there's no dollar limit on the amount of moving expenses that are deductible. Which moving costs are deductible? Jim drove down from North Dakota by himself in his car with the U-Haul trailer attached over a 2-day period. He spent the night while traveling in Oklahoma City. Judy and daughter Jessica drove down in Judy's car a week later, also taking 2 days and spending the night in Oklahoma City. Deductible moving expenses include travel costs for you and members of your household for travel from your old home to your new locality. It's not necessary for you and members of your household to travel together to claim a deduction for the expenses incurred by each family member. Since Jim and Judy each used their own car, they can either deduct car expenses based on the actual method or use the standard mileage rate. Actual expenses would include gas, oil, and repairs, but not depreciation during the trip. The standard mileage deduction uses a specific mileage rate for moving expenses, which is 17 cents a mile in 2017. Both actual and standard methods allow you to add parking fees and tolls. They decide to use the standard mileage rate because it's much easier to keep track of. You include all costs of lodging for yourself and household members while traveling to your new home. The nights spent in Oklahoma City on the drive down to Houston by Jim, as well as by Judy and Jessica, are fully deductible. You're also allowed to deduct 1 day of lodging after you move out of your old residence and 1 day of lodging on the day of arrival at the new location. Jim and Judy stayed in a hotel for the first week they were in Houston, while they were looking for an apartment to rent. Unfortunately, only 1 day of their stay at the hotel is deductible as a moving expense. You can deduct the cost of packing, crating, and transporting furniture and household belongings. You can also deduct storage for up to 30 consecutive days, insurance costs for the goods, and the cost of shipping an automobile to your new residence. Jim and Judy did all the packing themselves, so their moving costs consist of the cost of renting the U-Haul trailer and purchased moving boxes and packing materials. Jim and Judy's dog, Jojo, is a Saint Bernard. He doesn't travel well by car, so they elected to have Jojo shipped on an airplane. The cost of transporting a pet to your new home is fully deductible, so this cost of transporting Jojo by air is fully deductible as a moving expense. You can deduct the cost of disconnecting the utilities at your old home and connecting the utilities at your new home. However, the cost of connecting a telephone line in your new home is not deductible. When Jim and Judy left Fargo, they were in the middle of a 2-year apartment lease when they decided they just couldn't take the cold any longer. They had to pay a fee to get out of their apartment lease. Cancellation fees such as this are not a deductible moving expense. If part of the apartment was used as a qualifying home office, they may be able to claim a percentage of the lease cancellation fee as a home office deduction expense. Who can deduct moving expenses? The distance between your new job location and your former home must be at least 50 miles greater than the distance between your old job location and your former home. This is called the distance test. The driving distance from Fargo to Houston is over 1,300 miles, so Jim and Judy clearly meet the distance test. What is a home? For purposes of the distance test, a home can be a house, an apartment, a trailer, or something like a houseboat. It can't be a seasonal residence such as a beach house or a ski cabin. For Jim and Judy, their home was an apartment in Fargo. What is a job location? When you are calculating the distance for the distance test, use the job location where you spend most of your working time. If you work at multiple locations, use where you report to work as your job location. For example, if you work for several employers on a short-term basis and get jobs through a union hall system, the union hall is your job location. If you work at home, your home is considered your job location. How to calculate the distance for the distance test. You should calculate the shortest commonly traveled route in measuring the distance between your old home and the new and old job locations. The location of your new home is not taken into account when you apply the distance test. You only use the location of your old home. What if you move overseas? Jim and Judy briefly considered moving to Italy because they love Italian food. But if Jim and Judy moved overseas, their moving expenses would probably not be deductible, even though this move seems to meet the distance test. If you take a new job overseas and qualify for the foreign earned income exclusion or the housing exclusion, moving expenses applicable to the excluded income or housing exclusion are not deductible. Additionally, if you leave the U.S. to become a non-resident alien and your future income in the foreign country will not be subject to U.S. tax, you can't claim a moving expense deduction for moving to that country. But if you're a member of the armed forces, you may deduct the cost of moving your family to an overseas post. What about moving to the U.S.? Moving from a foreign country to the U.S. generally meets the moving expense deduction distance test. The same rules apply to a move to the U.S. as moves within the U.S. And the deduction is not limited to U.S. citizens and residents. An alien can deduct the cost of travel here to work at a full-time position. What about moves to take your first job? If you didn't have a previous job, your new job location must be at least 50 miles from your former home to meet the distance test. This rule also applies if you are returning to full-time work after a period of unemployment or part-time work. The time test. You must meet one of two time tests in order to deduct moving expenses. Either the 39-week test for employees or the 78-week test for the self-employed and partners. The 39-week test for employees. You must work in the area of the new job as a full-time employee for at least 39 weeks of the 12 months immediately following your arrival at the new job location. The 39 weeks of work do not need to be consecutive or with the same employer. There are a few exceptions to the 39-week test. The 39-week test does not apply to employees who become disabled and lose their jobs or who die. The time of temporary absences that are not your fault still count towards the 39-week requirement. Examples of temporary absences are illness, strikes, shutouts, layoffs, and natural disasters. If you lose your job and it's not your fault, the 39-week requirement is waived. If you resign or lose your job for misconduct, then you must still satisfy the 39-week test of full-time employment. How does retirement affect the time test? If you reach mandatory retirement age at your new location prior to meeting the 39-week test, the time test is not waived. The time test is not waived if you could have anticipated that you would leave your job prior to meeting the test, such as this example where you would have known you would meet the mandatory retirement age. How does a job transfer affect the time test? If you're transferred from your new job location for your employer's benefit, the 39-week requirement is waived. But if you initiate the transfer, the 39-week test is not waived even if the employer approves the transfer. Next, we'll discuss how moving expenses are deductible for members of the armed forces. Nothing can make up for the hardship of serving in the armed forces, but the U.S. government does provide some special tax breaks to soldiers. If you or a member of your family is in the armed forces, moving expenses are easier to deduct. You must normally meet the 39-week time test and the 50-mile distance test we discussed earlier to deduct moving expenses. But if you are a member of the armed forces on active duty and you move because of a permanent change in station, you don't have to meet the tests and can deduct your unreimbursed moving expenses. The term permanent change of station includes a move from your home to your first post of duty, a move from one permanent post of duty to another, and a move from your last post of duty to your home. There are some restrictions concerning the move from your last post of duty to your home. This move must occur within 1 year of ending your active duty or within the period allowed under the Joint Federal Travel Regulations. This move can be from your last post of duty to your home or to a point nearer in the United States. For example, John was stationed in San Diego, California for his last post of duty. After he was discharged, he continued to live in San Diego for 2 years. He finally decided it was too expensive to live in California and moved back to South Carolina where his family lived. Since he moved over 1 year after ending his active duty, the costs of this move to South Carolina are not deductible. A permanent change of station also occurs if the member of the armed forces deserts, is imprisoned, or dies. In these cases, the move is deductible if the spouse and dependents move to the member's place of enlistment or induction, the spouse's or the member's home of record, or a nearer point in the United States. Sometimes it's necessary for the military to move the spouse and dependents to a different location than the member of the armed forces. In these cases, the moves are treated as a single move to the new main job location. Do not include in income the reimbursements, allowances, or the value of moving and storage services provided by the government to move the member and the spouse and dependents to and from the separate locations. You do not include in income the value of moving and storage services provided by the government due to a permanent change of station. Amounts excluded from income include dislocation allowance, temporary lodging expense, temporary lodging allowance, or move-in housing allowance. If the total reimbursements or allowances received related to the move are more than your actual moving expenses, the excess is included in your wages on Form W-2. Even if the excess is not included in your wages on Form W-2, the excess must still be reported in gross income on the Form 1040. Remember, though, the allowances for dislocation, temporary lodging expense, or move-in housing are excluded from income, even if they exceed the actual costs incurred. Deductible moving expenses for a permanent change of station follow the same rules as for a typical civilian move. These costs include moving household goods and travel to the new location. Deductible costs also include the cost of storing and insuring your household goods for any period of 30 consecutive days after the date these goods are moved from your former home and before they are delivered to your new home. Foreign moves include a move from the United States to a foreign country or from one foreign country to another foreign country. It does not include a move from the foreign country to the United States, which is considered a normal domestic move. In addition to the normal deductible moving expenses, a foreign move can also include moving your household goods to and from storage and storing these items for part or all of the time the new job location remains your main job location. The new job location must be outside the United States. So in other words, if you make a foreign move, you're not limited to the 30 days of storage that you're limited to with a domestic move. Form 3903 is used to deduct qualified expenses that exceed your reimbursements and allowances. Allowances do include the dislocation, temporary lodging expense, or move-in housing allowances that are excluded from gross income. Do not deduct any expenses for moving services that are provided by the government. Also, do not deduct any expenses that were reimbursed by an allowance that you do not include in income. For moving expenses to be deductible, they must be incurred in connection with the move. Expenses occurred within 1 year of arriving at the general location of the new place of employment will automatically meet this requirement. Expenses incurred later will also meet this requirement if the delay is due to circumstances such as the inability to move the employee's family for a period of time. For example, Jim moved to Houston, but Judy and Jessica stayed behind in Fargo for 2 years so that Jessica could finish high school there. The costs of Judy and Jessica moving to Houston 2 years after Jim moved there are still considered to be in connection with the move and are fully deductible. The IRS provides a long list of non-deductible expenses in Publication 521. You can't deduct any of the following as moving expenses: any part of the purchase price of your new home, car tags, driver's license, the expenses of buying or selling a home, including closing costs, mortgage fees, and points, the expenses of entering into or breaking a lease, home improvements to help sell your home, a loss on the sale of your home, losses from disposing of memberships in clubs, mortgage penalties, pre-move house hunting expenses, real estate taxes, the refitting of carpets and draperies, return trips to your former residence, security deposits, and storage charges except those incurred in transit and for foreign moves. You obviously can't take a moving expense deduction and a business expense deduction for the same expenses. But there could be situations where you can take a business expense deduction that is related to your move. For example, let's say that after the family moved to Houston, Jim had to return to Fargo for 2 weeks to complete a business project. Since this 2-week project would be considered a temporary assignment in this case, he could take a business expense deduction for his travel, lodging, and 50% of his meals during that time. Retiree and survivor moves. Generally, moving expenses are not deductible from income unless they are connected with a move to a new job and you meet the time and distance tests. If you're living in the United States and decide to retire and move, that move is usually not deductible because you're not moving to take a new job. You don't meet the work time test. For example, if Jim and Judy were working in Utah and decided to retire and move to Arizona, this type of move would not be deductible. But there are some exceptions for retiree moves that are deductible. When is your retirement move deductible? There's an exception to the time and distance tests for Americans living abroad. If you're working in another country and decide to retire and move to the United States, the cost of your move may be deductible. When making this determination of a deductible move, the United States includes the possessions of the United States. The requirements for deducting retiree moves are that your main job location and your former home must have been outside of the U.S., and you must intend to retire permanently. When you quit working full-time for compensation, you're considered permanently retired. You can retire from outside employment or self-employment. If you lived overseas with a spouse, dependent, or someone you were a dependent of and choose to move back to the U.S. after his or her death, you may be able to deduct moving expenses. Requirements for deducting survivor moves. You moved to a home in the U.S. You initiate the move within 6 months of the decedent's death. The home you moved from was both the decedent's home as well as your home, and it was located outside of the U.S. Reimbursements of moving expenses. Employees can receive reimbursement for deductible moving expenses paid under an accountable plan or a non-accountable plan. These payments must be only for deductible moving expenses for moving household goods and travel at the time of the move. These reimbursements follow similar rules for travel and entertainment reimbursements. Reimbursements can also be paid to employees for non-qualified moving-related expenses. These payments are treated as compensation. If the employer pays directly or reimburses moving expenses that meet the following criteria, the plan meets the accountable plan standards and the amounts paid are excluded from the employee's income. Expenses must meet the requirements for deductibility under Section 217. The employee must furnish an adequate accounting of his expenses to the employer, and the employee must return any excess of advances over expenses. If an employee is fully reimbursed for what are deductible moving expenses, the reimbursements are excluded from income and appear on the W-2 as non-taxable reimbursements. The total amount of qualified reimbursement is reported in Box 12 of the W-2 using Code P. Since the employee has been fully reimbursed for moving expenses, the employee does not take a deduction for them. Just like with travel and entertainment expenses, employees must document their moving expenses. Adequate documentation consists of receipts, invoices, and canceled checks. You should also maintain a logbook where you enter each expense at or near the time you incur it. Expense accounting, reimbursements, and return of excess reimbursements should all occur in a reasonable period of time. Although the specific facts and circumstances of an individual situation can impact what is considered reasonable, the IRS provides the following guidelines of reasonable periods of time. If you receive an advance within 30 days of the time you have an expense, if you adequately account for your expenses within 60 days after they were paid or incurred, if you return any excess reimbursement within 120 days after the expense was paid or incurred, and if you are given a periodic statement at least quarterly that asks you to either return or adequately account for outstanding advances and you comply within 120 days of the statement. A reimbursement arrangement that does not meet the three rules listed earlier under an accountable plan is considered a non-accountable plan. For example, if the employee does not provide receipts and substantiation within 60 days, this payment could be treated as paid under a non-accountable plan. Also, the following payments are treated as paid under a non-accountable plan: excess reimbursements that you fail to return to your employer, reimbursements of non-deductible expenses discussed in the next slide, any reimbursements paid by salary reduction. With the exception of the shipment of household goods and travel to the new location, any relocation expenses that an employer reimburses or pays on behalf of an employee must be included in the employee's gross income. That payment or reimbursement is treated as if it were paid under a non-accountable plan and is subject to withholding and employment taxes. Examples of employer reimbursements for non-qualified expenses are payments for home sale expenses, temporary living, and house hunting trips. Other costs sometimes paid by employers as part of a relocation assistance package include loss on the home sale or payments for new home purchase closing costs. All of these non-qualified moving expenses must be reported as income, and as a result, the employee will have to pay taxes on these reimbursed expenses. Many employers make an additional payment, commonly referred to as a gross up, to help these employees with this added tax liability. This gross up payment must also be reported as income and creates an additional tax liability for the employee. The employer is entitled to a deduction for payments made to facilitate the employee's job-related move. These expenses are deductible as ordinary and necessary business expenses and can be deducted regardless of whether or not they are characterized as compensation to the employee. Any payments made under a non-accountable plan are added to the employee's total wages in Box 1A of Form W-2. Employers must withhold income tax, Social Security, and Medicare taxes from reimbursements and allowances paid that are included in the employee's income. Employers should not include in wages and should not withhold taxes from any payments that are made under an accountable plan for moving expenses that were deductible. These reimbursements are reported in Box 12 with Code P on Form W-2. If the employer has an accountable plan and reimbursements are made for both deductible and non-deductible expenses, the employer must determine how much of the reimbursement is not taxable and not subject to withholding. Any remaining amount is treated as taxable wages and is subject to withholding. A typical relocation package will have both deductible and non-deductible expenses such as house hunting trips. The amount of tax withheld will depend on whether the reimbursement is added to your normal wages or paid separately. It will also depend on information on the Form W-4 that has been provided to the employer. The employer can elect to treat reimbursements as supplemental wages and not include the reimbursements with regular wages. Income tax can be withheld on supplemental wages at a flat tax rate, which may be different from the employer's regular tax rate. Reimbursements of moving expenses. Where do you claim moving expense deductions? You claim the moving expense deduction as an adjustment to gross income on Form 1040. You can claim a moving expense deduction both when you claim a standard deduction or if you itemize your deductions. Moving across the street or overseas, don't forget to tell the IRS. Regardless of if you are moving across the street or moving abroad, it's important to let the IRS know. The Internal Revenue Service always uses the taxpayer's address of record for the various documents that are required to be sent to a taxpayer's last known address. It's important to update your address information so the IRS knows where to send your refund or any correspondence. You can update your address with the IRS by completing Form 8822, Change of Address, at any time during the year. The failure to notify the IRS of an address change recently prevented a taxpayer from contesting a lien for unpaid taxes. The tax court ruled that the taxpayer didn't actually have to receive the notice of the tax lien in order for the lien to be valid. In this tax court case, Duplicki versus Commissioner, the court sided with the IRS. The tax court concluded that the lien sent to the taxpayer's last known address was valid since the taxpayer didn't prove that he provided the IRS either directly or indirectly, i.e. through a change of address card, with a clear and concise notification of his change of address. Don't let this happen to you. It could be very costly if you do not respond to a notice from the IRS.